Hello, YouTube. Welcome back again to another trading update, shall I say. Not really a pod, this one, but more of an update on what's going on, what's happening right now. It's been a bit of a time since we last had an update together, and I mean, it's still all going off. We've actually had quite a nice rally in this market, which has really, just helped the old portfolio sort of settle the nerves a bit, helped me get a little bit of positions off. But the main thing I want to talk today about is natural gas. We've actually got, it's one of the biggest topics right now. We had today the European Dutch natural gas, TTF gas as it's known, the European one, has now hit the highest again almost this year, reaching almost 200 euros per megawatt hour. And US natural gas today hit the highest since 2008, getting above that 9 level. And UK nat gas also pushing higher, up 17% today. So there's been a bit of a crazy wild one for nat gas. And what is going on? Let's just look through it right now. So, I mean, it's all doing with Russia. Russia are just toying with Europe. Europe, especially Germany, sold their souls to the devil, so to speak. They export about 14% of their natural gas supply. So out of their overall energy supply is exported out of Russia. They also export coal out of Russia. And at the same time, their nuclear fuel, they're trying to phase it out. So now they're in a bind. What do? They need this nat gas, and Russia knows this, and they're playing this to their advantage. So what is it all coming over to? Is the Nord Stream 1 pipeline. So apparently this pipeline needs maintenance. There's 6 turbines in this pipeline that they need maintenance, and Siemens are the ones, which is a German company, by the way, is the company that is responsible for delivering the parts over to Russia to perform their maintenance on. The part was in Canada, and Siemens claim they've sent it, but Russia claims they have not received the documentation necessary to take delivery of it. We're talking about documentation here, like someone signing something. This is holding up huge flows of gas that's really crimping Germany right now. And as of now, Germany are getting around 33% of their requested flows of natural gas. You know, 1/3. It's a bit of an issue. So let's just look at a bit of a timeline. I'm going to be using Trade the News here to look through the progress of what's been going on over time. First of all, let's look at a chart. This is a chart of the natural gas, the EU Dutch TTF, which is a European measure of natural gas. Now, currently is trading close to 200 euros per megawatt hour, and that will put it up around 13% for the day and 54% for the month, and over 400% for the year. So you can see what we had. We had these spikes, which were on Russian headlines, but then we quickly faded it. But since mid-June, realistically, so about a month, we've had a sustained move higher, which is actually not the type of action you want to see. You would rather have this sort of brief spike and then a fade than this sort of steady grind higher. And then we set around 152, and now we've gone back up to 200 as this. So we already had the issues with one turbine. Now they're saying a second one needs maintenance. And the question is, how long is Russia going to keep on pushing this on? There's 4 more turbines after this. Are they going to continue doing this, dragging it out, trying to ease the sanctions on them for, basically holding Europe ransom in an effort to ease some of the sanctions placed on them. So right now we've got 200 here. If we look at US natural gas, is actually at 894, but we actually had a spike today. If we look on a one day chart, we can see that we were trading around 897, and then some stops must have gone off, and we almost hit 10. A huge spike, but we've faded the whole move, which has been good in the US front. And then in terms of the UK gas future, this is still well below the highs, which we actually hit in March, which actually reached around 540. But again, we're trading an uptrend. We're up from 133 to 376, so still a 300% rise in UK natural gas. So this ain't going to help, and especially if this drags on. We're already coming into August right now, and if this drags on to the winter, there's going to be a real problem because, I mean, the winter, It's really going to put pressure on households, and I don't know how these governments are going to try to get out of this one. I mean, again, the same view I've had before. We need to try to come to some sort of agreement with Russia and talk through peace. This current rhetoric ain't winning, right? Russia's still getting their gas. They're still exporting their oil to India and China. They're not losing out. And the thing is, they're just going to hold out. But in terms of some of the news that's been happening, so the most latest one now, we're having Russian press saying that according to Kremlin insiders, the Russian authorities are said to continue to find reason to keep gas flow to EU at minimal levels in order to raise pressure on the EU leaders to reconsider sanctions against Russia. So that is what's the latest headline. And on the 25th of July, we did see Gazprom, which is the company in charge of the Nord Stream pipeline, saying that it announced it would limit flows via Nord Stream to only 20% of capacity from July 27, citing the need for routine maintenance on a turbine that feeds gas into the link. And right now, Europe is by far Russia's largest export market for gas. So Gazprom are saying they need these parts, they need these documents. Europe saying it's already been sent to them. I don't know what's going on, but considering the severity of the situation, it all just seems something that Europe really needs to hasten. Russia's classic delaying tactics, working at a really slow pace to try to to try to stifle, to keep on squeezing these Europeans. And Europeans are now talking about limiting the gas use by around 15%, cutting gas use by 15%, which has met opposition from a lot of companies saying, how can they even operate with 15% less gas use? And it really put them at a disadvantage. So this is the situation, and this is why we're having gas prices going through the roof, especially in Europe and the UK. So this is what's happening right now. Now, we've seen gas prices. Crude oil, on the other hand, is trading lower, is around 94.82. Now, we had that record high, well, not record high, but recent record high in the inflation print out of the US last week, which was over 9%. And again, we actually initially came up and then reacted positively for the rest of the week. And again, a lot of that information in that CPI print didn't count the recent downturn in commodities. We had wheat, lumber, a lot of the grains, oil, they've all dropped off 10 to 15, 20, 30, 40% from the highs. So the thing is that we sort of expected that the real number we were really looking at is the July reading for CPI. And we only got a few days left in July. So this should definitely show a lower print because we've had much cheaper gasoline. Over here in the States, gas prices are down around 20% from the high, averaged out. So definitely seen a drop from there. And if you look at the year-on-year comparison, from a 98% increase in June, we're looking at about a 35% increase in July. So that should really push down the number. The question is, what's the core number looking like? And so we'll see what that number is when it comes out in a few weeks. But crude is dropping to around 94.77, is consolidating below that 100 mark, which is positive for the inflation front, but still nat gas is the real thorn in the side right now. So it'll be interesting what happens. Again, Russia just peddling with Europe, and it's about who's going to blink first, who's going to sort of give way a bit in this, nip and tuck between the two to try to solve the situation. Again, my thoughts, as I mentioned before, is that with Putin, he does not care. He's just trying to win this war. Like the Russian people they can't really rile against him to the same level that the European or even the American people can rile up against European governments and US governments. And so the thing is that there's much more pressure on these Western governments to try to get down the price of these, especially natural gas and energy, especially coming into the winter season. We got August, September, maybe a bit of October, and then literally in 2.5 months, if we're at prices anywhere near what they are now, there's going to be real trouble ahead, and that could really be the catalyst for a recession. And talking about recession, on Thursday, we actually have the US GDP number. So we had a reading of minus 1.6% in the prior quarter, and this quarter, forecasts are for around 0.4%, but it could be well and truly a negative number once again. And again, it's not what's happening now, it's the last 3 months. And so if we were in a recession, it's already happening. But again, I feel like it's an economy of two tails. I feel like the upper echelon of earners are doing pretty well still. There's so much demand on the flight space for leisure. Car sales are still booming. But on the lower end, there's a lot of squeezing happening, especially with these rising energy prices and general rise in cost of goods. We actually had I think it was the CFO of LVMH just speak right now after LVMH did report their earnings, and they did allude to the fact that more people are spending on the cost of servicing, like just the natural amenities to run a household, which is leaving less money to spend on goods. And that also was mentioned by Walmart, and Walmart had a pre-announcement yesterday which dropped the shares 9% as they did cut their guidance, and we'll go into that in 1 second. But for US GDP, we're expecting 0.4%. Now, again, I could easily see this being a negative number, and just for technicality purposes, that would mean a recession, 2 quarters of negative growth classified as a recession. So that could possibly be there. So we could see that on Thursday. But the Fed, I'm pretty sure, has this number already, because tomorrow we have the FOMC rate decision. Now, after the CPI print, we had in the prior quarter, the June CPI print, which was over 9%. There was huge bets that we were going to get a 100 basis point rise, but the Fed really did push back on that rhetoric, especially given where commodities are now. So that number was a bit backward looking, and you could just see it in the futures where the commodities are. So the thing is that it seems to be the general consensus that it's 75 basis points, and it definitely looks like that is pretty much a certainty. I'll be very, very surprised if it's 1%. The only way is if they're seeing something we're not. If there's still a very strong GDP number, then maybe they might. But I pretty much think this will be 75 basis points. That will bring us up to 2.5%. And this is after the Bank of Canada raised 100 basis points in the last rate meeting. ECB last week done a surprise 50 basis points over the 25 expected. But again, the general rhetoric of these central banks is get ahead of the curve, raise a lot now, so then it gives them more flexibility going forward. Like the prime mandate for all of these central banks is get inflation down over anything else. So we have 2.5% forecasted for rates by the FOMC tomorrow. It'll be interesting to see the commentary, as always, in the statement and the press conference afterwards from Jerome Powell. And the real question is, will there be any talk? Did any of the members push towards a 1% hike? But judging by the speak, it doesn't seem that way. But so 2.5%, 75 basis point rate hike is on the cards for tomorrow. So we've got 2 days of quite important economic data, obviously the Fed meeting, and then after that, the advanced GDP reading for the current quarter, and the quarter that just went past Q2. So it'll be interesting to see what that brings about. Now, let's go on to some charts quickly, look at where we are on the S&P. S&P currently trading at around 39.17. So we're trading at 39.17. This chart hasn't actually updated, but you can see that in the last pod, I believe, on a couple of pods ago, we did break that lower trend line, and we sort of bounced off this level over here, the red line. And then we had a really strong bounce, and this was actually following that CPI. That was from June. And then since then, we've sort of gone sideways, and we've hit this double top over here, and we broke it again just last week, which was an encouraging sign. So now we're consolidating above this level. We can't crack that 4,000 quite yet, but we are making somewhat lower highs. Higher lows. So we bottomed there. We had a wick here. We had a very big pin bar there, but the actual where we closed was marginally above the low that we witnessed on the 1st of July. And then we moved on strongly from here, and now we're trading just below that 4,000 mark. So we are in an uptrend right now, but we do have some key earnings this week. We've got Google and Microsoft that are reporting earnings after the close. Then we have Amazon and Apple as well, I believe on Wednesday or Thursday. We had Tesla last week, which had that big run. It pushed from about 730, went all the way to 840, and now we've just pushed back below 800 as we're selling off once again, being weighed down by recession fears and predominantly Walmart. So let's talk about Walmart right now. Walmart, the US retail bellwether, is actually sinking a lot of these stocks. Now, yesterday we did get a reading from them. Here we go. So yesterday they did cut their Q2 outlook and their 2023 profit guidance, primarily due to pricing actions aimed at improving inventory levels at Walmart's and Sam's Club in the US and a mix of sales. So basically Walmart, the way I read this is they're taking it on the chin to try to not push up prices too much because they know the effect, because their sales guidance has actually been raised. So if we look at what they cut their EPS by 8 to 9%. Their prior forecast was EPS to grow flat to slightly higher. Now, they raised their revenue to be up over 7.5% from a prior forecast of 5%. So they're going to be doing more revenue, but less profit. So Walmart is doing like what Tesco, I believe, is doing in the UK. They're taking it on the chin a little bit, foregoing a bit of profit and generally absorbing more of the higher costs, so they don't push it onto the consumers as much because they know it's very sensitive time. And just reading by that, and this is what I get from it. So this, it's noble of them, if that is what it is. That was for their Q2 for 2023. They now see EPS down 10 to 12%. Their prior forecast was EPS to be down 1%. So that's quite a big hack there. But revenue seen at around 5.5% higher. Prior forecast was 4%. So again, higher revenue, expect more people, to come to Walmart to buy lower priced items, but again, at the expense of profitability for Walmart. Also, what's been hampering a lot of these companies is currency headwinds. Now, we see from Walmart, they say net sales include a headwind from currency of about $1 billion in the second quarter. And based on the current exchange rate, the company expects about $1.8 billion in headwinds in the second half of the year. So there you go. This is a common theme for many of the US companies, citing currency factors, which is hampering a lot of their repatriated funds from foreign sales. They also maintain its expectations for Walmart US comp sales growth, excluding fuel, at around 3% in the back half of the year. So this Walmart move, we can see where we're trading right now, about 121.57. It's down around 8%. We've actually bounced a little bit from the initial low, which was touching on 120. Now, a reminder that Walmart did disappoint in their prior earnings, and that's when we had that move from 148 all the way down to 131, and that eventually led to a move all the way below 120. So on this current move right here, we haven't actually broken the prior lows that we got at the end from the prior earnings, which was just below 120. But we can see if there'll be follow through, and that will largely also depend on just the overall market. And the market is definitely taking a breather right now. So, I mean, with Walmart, we've got two large gaps here. Got $11 gap here, and then we've got the gap over here. So eventually, let's see if those fill on a technical basis. But for Walmart, this is what we have at the moment. And that is pushing again. Like I said, the retail is down. The retail ETF is down around 3.5%. Many of the retailers are down, down quite big, a few percent to well over 10%. So we'll see. And we're also seeing some of these, like SoFi and some of these companies related to demand also waning and falling on the back of, this perceived demand destruction, which is the goal of the Fed to try to get inflation down. Now, just before we end it for today, let's look at today's earnings. So if we look at earnings whispers, today after the close, we are looking at Microsoft, looking at 228, 52.9 billion. Google as well. We've got Visa, Chipotle. So, I mean, those are three of the big names reporting. So that will be, that will have definitely an impact on the market for this week. But again, I don't think it will have as big of an impact as it would have had in prior quarters, because I think macro is definitely the leading theme right now. And if we look at Wednesday, we got Spotify in the morning, T-Mobile. And then I believe, is it Wednesday after close or Thursday? We have, well, after close on Wednesday, we've got Ford. So it looks like definitely Apple and Amazon are reporting. Oh, we got Meta as well on Wednesday. And on Thursday, we've got Apple and Amazon reporting after the close. There we go. Yeah, Apple and Amazon. And just a quick look at how we're trading, how we're looking at in the average trader portfolio. It's been obviously a bit difficult, but there's still down about 9.6% on the 10K base portfolio, but there's a few positions that are looking pretty good right now. US Steel is expected to is expiring at the end of this week. So far, we're looking good. It's trading just above 20. We've got a 19.17 put spread. Again, they've got earnings on the back of the 28th, so hopefully they're not bombing, considering they're in the steel industry. So we'll see if that derails that position or not. But I'm just holding out because there's still quite a bit of premium. And I put on a few more positions, and now they're more focused towards the metals and rather than the individual stocks. We had put a silver position, as silver has been smacked. Gold, we have that. We have XOP, which is the oil services ETF, as well as SCCO, which is copper company, which largely tracks the price of copper, and also Nat Gas. So with this big move in Nat Gas, I've basically put on an iron condor, hoping that we sort of realistically sort of fade in the next month from the highs that we're at now. And hopefully that will be the case. So those are the positions I put on right now. But as you can see, after like a pretty rough middle patch of the year, I've sort of changed the risk profile a bit, which has actually helped the trading quite a bit. And it's been quite a few winners. But the main thing is that my losers are much less than some of the earlier positions I had, which were a lot of $300 plus losers. Now it's more limited to like 180, 240, 150. So it's sort of helping make up those losses with these sort of gains that I've got right now. So we'll see how that all